Hello, this is Mike Swanson. I run the website WallStreetWindow.com. And in this video update, I want to talk about what's going on in the stock market. I got to tell you, thinking about it over the past couple of days, and I think there's more excitement now that I'm hearing from people in person, in email, and on the internet that I read than perhaps there's been all year. And at the same time, there's a lot of reasons to be skeptical about the market rally. But people have been skeptical in the past and been wrong too. So what's going on? Is this rally for real or not? Well, there's three components to the market that we need to examine and look at and think about. We're going to do it in this video. It's price, investor psychology, and the news, how the news is driving the stock market and what the news really is. So let's break these down real quick. I got to show you what I'm looking at. Here's a simple price chart of the S&P 500. And what's driving all the excitement this year, or at the moment, is that if you look at the bottom of this chart, I've got a ROC indicator. That's rate of change. That's the rate of the price change I got over 30 days. And it plunged down 15% over 30 days in May. But now it's up almost 9%, in the past 30 days. So that's a big shift of momentum going down and momentum going up. And that's the biggest upward momentum we've seen in the stock market in a 30-day period in over a year and a half. So that's what's getting people back into the interest, and some people buying, some people now saying, I'm going to turn on my app, start looking at what's going on. However, this upward thrust, the market is still below its highs, obviously, but it's also below its 150-day and 200-day moving average. It's below resistance levels that it needs to break out of to really enter a new bull market. In fact, when we look at the market now, we can see what the next price resistance levels are that the market's going to have to deal with. And we've broken through Friday, the first such resistance level, which is the 1/3 retracement of the June low and the market peak in January. Historically, that becomes a resistance level. We busted through that, closed above it on Friday, and now the market is really approaching the 50% retracement level, which is around 42.50, which coincides with where the 150-day moving average is. So write that number down, 42.50. And right now the S&P 500 is at 41.30. So you're looking at 130 points. One, if wants to, just do a day trade or a quick trade, could play a trade here on, say, SPY for such a price gain, or buy some stocks that are outperforming the market and just get out for a short-term gain. If you just want to try to day trade, play short-lived route, play for a short gain if the market continues to go up, you'd have to still limit your risks if you're wrong. But what if you want to invest? Well, what I'm basically implying here is that the short-term price momentum is up as we ended last week, but the long-term price momentum trend, which is bearish, has not yet been broken. The market needs to go through that 50% retracement level. It needs to close above the 150-day and 200-day moving averages. Those are the most important indicators right now in the entire stock market. You see, in a bull market, the market trades above the 150-day and 200-day moving average, and those indicators act as support. In a bear market, it trades below it, and it acts as resistance. The last time the market, we had a rally back above it in April, and then it stalled out and really took a bad tumble. So we run the risk the market simply rallying back above that level and peaking out and going back down into the end of the year. And just simply based on what I'm saying in this chart, I'm not trying to predict one way or the other. I just want you to think about it and understand 4250 is the next key level, and whether this is truly gonna, stop being a bear market and go into a bull market, it's gonna take time to determine that. I want to think logically about what's going on. I'm not here to hype you up. I'm not trying to, make you do something with your money or buy a service. I'm just want you to think logically about the market and approach the market from a logical manner. And when it comes to analyzing the market, these three components: price, psychology, news. Price is the most important thing. Psychology is not bearish on the stock market when it comes to what people are doing with their money. I did a video a couple of days ago about the VIX. The VIX measures what people are doing in the options market and paying premiums for volatility to hedge positions, and the VIX is down. Last week it went close below 22. The VIX gets above 35, really above 40, when there's panic that coincides with panic bottoms. We have not seen that all year. We've not seen a true panic bottom in the market, a panic washout. Nothing like what happened in the fall of 2018, much less the spring of 2020. In 2012, there was a panic flash crash. In 2011, there was a panic flash crash. 2009, of course, there was a huge washout in March, then that bear market of that cycle. 2008, there was a crash. In 2017, there was a panic flash crash in which the Dow fell 1,000 points a day and the VIX went above 40. The VIX got up to 39 on the open when I think that was the day that Russia announced it was invading Ukraine. But really, over the past several months, the VIX has been falling. There's no panic washout on this recent bottom in the market, the last one that happened June, at all. So that's what's going on. And there's going to be other indicators. If this rally does continue for more weeks, that we can follow to detect if it's coming to an end. And I got friends I talk with that they got their own indicators. ICIOSA, for instance, is one of them. But anyway, VIX is one way to measure psychology. But when it comes to psychology, think about things this way. This is a long cycle that can play out for a year or 2 or 3 years. But bear market bottoms come when there's despair, capitulation, mass selling, true fear. I do believe we've seen fear in the market in the sense of people being uneasy, inflationary pressures, what's going on in the economy, declining stock prices, declining poll numbers of the president. The current president is an indication of people not being happy with the current situation. So there's no doubt of uneasiness in society, but no true fear is showing up in capitulation selling or mass selling in the market. In fact, statistics show that we've seen massive money flows from individual investors this year. May saw in 1 month more money put into the market, into funds, into stocks by individual investors than ever before. That's not a sign of fear at all, and that was happening, on the recent low here. So keep this in mind. There's no signs of a classic bear market bottom, and that's reflective also in what you're hearing people say in the financial media. To give you one example, the biggest guru of the bull cycle since 2020 has been Cathie Wood. This is a story this weekend. She's declaring the bear market is over and buy growth stocks. What's important about her isn't so much what she's saying. I may do another video about her in a couple of days. But what's important about her is she remains the number one guru. she remains the number one guru. And in past bear market cycles, what will happen is there'll be new gurus that displace the bull gurus and become really popular for a period of time, perhaps even a couple of years. I can't remember the guy's name. Peter Schiff got big in 2008. There's some guy's name I'm slipping my mind. I think he was a European that was big for a couple of years and then kind of faded away. Mark Faber was another one that got big in 2008. They weren't big before then, and then in the financial media, whether that's on TV or on YouTube, but then they became big. But there's no new bear guru that's displaced Cathie Wood. So I really can't see. I cannot make an argument. I don't think anyone really can that we've gone through a complete bear market cycle here. As far as news goes, the news is the most difficult thing to base decisions on because you get conflicting cross currents and even misunderstanding and misinformation all over the place. So for instance, right now, people are making this argument that the Fed, one interesting thing that happened last week is when the Federal Reserve made its decision, the market rallied that day, and then it rallied the next day. The other times this year when the Fed had a meeting, the market dumped the next day. So that was one thing different last week than what we'd seen before. It is a suggestion that the short-term momentum can have more follow-through this week, this month, and we'll see. But I think people are overestimating. There's a narrative out there that the Dove has made a huge pivot, that they're no longer hawkish on interest rates because he made an adjustment Jerome Powell made a slight adjustment in his statements saying that he was going to wait before making, big claims of what the Fed's going to do at the next meeting. They're going to wait for more data to come out. He wants to see if inflation is not as high as it has been. And people took that as a dovish shift. Well, I think it's just that the Fed isn't sure if they're going to raise rates by a quarter point or 50 points at the next meeting. And I think people are overestimating the implications of that. And in fact, I think the Fed is much more worried about inflation as people believe. In fact, I did an article showing the Federal Reserve statements saying that in a video last week about 1974 and the lessons the Fed is drawing from that. Now, if you want to play, and also we're seeing, I think the evidence suggests that the economy is beginning a contraction phase. We saw 2 negative GDP quarters, but the unemployment rate remains low. There's still a big job shortage. Now, people are saying, well, that means the economy is strong. That's what Joe Biden said. But I think that suggests that we're just peaking in an expansionary economic cycle. And we're only starting a contracting cycle, only just beginning it. Real estate prices, the momentum in them kind of has stalled out. The home building numbers have come down, and that has just happened in the past 2 months. Well, that's a cycle that is likely to play out, through the end of next year. It doesn't mean housing prices are going to crash. I'm not saying that. I'm saying that the huge boom in expansion in real estate has stalled out, and it's not, going to resume the charge up next week. It probably won't. It's just the way things go. They ebb and flow, and we're on an ebb, and we're on an ebb in the economy. And a sign of that is what a lot of companies have been saying. Walmart has said that they're seeing weakness in consumer spending. And one of the ways they're reacting to it is they're going to create a refurbished product program in order to cater to people who have to tighten their budgets and can no longer afford to buy new stuff. Now, if that's not a disturbing indication of what's going on in the real economy, I do not know what is. That's the biggest retailer in the United States. So, what do I want to leave you with? I haven't said anything about gold in this video. I did a video just 2 days ago talking about gold with Jordan Roy-Byrne. I'll link to that. If you missed that video, watch that if you want to see my latest thoughts on gold with him. But what do you take from all this? The stock market can be so confusing, the news cross currents and this and that. And then especially, don't think too much about the news. Don't try to draw huge conclusions from what people are predicting about the market. So many of these, no one can really predict it 100% of the time. And what will happen is in the market, you can find someone that's good, seems to be hot 1 year on their predictions, then the next year not so hot. Cathie Wood last year, for instance, was saying that inflation was temporary and would just go away, and obviously that was wrong. But the year before, she was red hot. Now, the best thing to do then is don't try to predict the future, but keep your eye on the price trends. Keep your eye on that, because that's the most reliable indicator. And it changes, and it's those changes you need to adapt to. So what are the price trends? To sum up, the short-term trend remains up. We broke through one resistance level last week after the Fed meeting, which is something that has not happened this year. That suggests the short-term momentum is up. However, those long-term price resistance levels, and the first key one being really that 4250 on the S&P 500, have yet to be breached. So we're looking at a short-term rally within a long-term, still a downtrend. Good chance, though, that resistance level can be tested this month, and then we'll have to, watch that, see if it changes, and so forth. But I got to tell you, if you want to play rallies, if you want to play stocks, you want to play sectors, the best way to do it is always stick with those things outperforming the stock market and avoid those things lagging the market, and use rallies to sell such positions or such ETFs that you may own. Because when the rallies end, those things tend to fall worse than the stock market. When the market rallies, they don't make up for the big losses they took. They are millstones on a portfolio. And there's a lot of stuff in the market that remains in that situation. So let's see what happens this week. If you're new to my videos, hit the like button and then hit like. So I know I'm trying to do all kinds of different content and subjects that I know this is stuff you want to hear more about. But if you're new, hit the subscribe button and then hit the bell next to it. And then YouTube will send you an alert as soon as my next video is up, and I'll be talking with you later.